Hello everyone, this is Dr. Zhao. In this video, we will continue discussion on portfolio performance evaluation. And in this section, we will focus more on performance attribution analysis. As I said, performance evaluation not only show the performance of the fund to their clients, but also it's a very useful tool to improve internal management. And this performance attribution analysis is a powerful tool for manager to understand where is the weakness and where is the strength of their past portfolio management practice. And performance attribution analysis is a process where we can decompose overall performance into several different components, and those components have something to do with the decision-making process of a money manager. So what does a money manager do for their investments? Well, they make investments decisions for their clients, and essentially speaking, they make two different types of decision. The first one is asset allocation. Asset allocation decision is a strategic asset allocation or tactical allocation. Asset allocation, and the second decision that they make is individual security selection. Individual security selection. So through this attribution analysis, we can see the contribution of those two different investment decisions to their overall performance. Now let's take a look at one simple example to see how we can do so-called attribution analysis. Before we do attribution analysis, we need to establish a benchmark portfolio, which we call this as bogey portfolio. And this standardized bogey portfolio is unmanaged portfolio, which involves no asset allocation decision, no individual securities selection decision, and it's a passively managed portfolio. And this represents the benchmark for our comparison. And in this typical bogey portfolio, we see that 60% of money are invested in equity market, and it's passively managed equity portfolio which tracks the performance of S&P 500, and 30% money were put into bond portfolio, and this bond portfolio tracks Lehman Brothers bond market index, and also this portfolio has 10% in cash or 10% money invested in money market instruments. And during the last year, let's say stock market has 5.8% return. Not last year, but during the last month, and the bond market delivered a 1.45% return, and the cash market or money market instruments delivered a little less than 5% return. So once you come and weighs and the returns for three different asset classes, you can calculate average return. Average return 3.97%. 3.97%. Now let's take a look at a managed portfolio. A managed portfolio, and this managed portfolio actually delivered 5.34% of total return during the last month. So here you found excess return of this managed portfolio, which equal to 1.37%. 1.37% may not seem a lot for you guys, but if you time this 1.37% on, let's say, $100 billion US dollars or $1 trillion US dollars, that's a lot of money. That's a lot of money. But anyway, the excess return of this managed portfolio is the actual return for the portfolio minus the return on the benchmark portfolio, right? 1.37%, or you can say that as 137 basis points. So the question here is, what are drivers for that 137 basis points of excess return? Was the manager really smart picking individual stock? Or was the manager extremely smart in making asset allocation decision? Well, we're gonna do attribution analysis to see how those two decisions contribute to this 137 basis points of excess return. And in this table, we have two subtables, A and B. And the table A showed you how to analyze the contribution of asset allocation decision to this excess return. Right? So here we have three asset classes in this managed portfolio: equity, fixed income, and cash. As you see in the benchmark, we have 60% in equity, 30% in fixed income, and 10% in cash. But in this managed portfolio, manager make asset allocation decision. Right? They decide to do differently, and instead of investing 60% in equity market, they invest 70% in equity. So the excess weight for the equity is 10%. This is the asset allocation decision made by the manager. And instead of putting 30% in bond market, they put only 7% in the fixed income securities. And also for the cash, they have 23% of money on the money market instruments. So you see the weights are different from the benchmark. And the excess weight here shows you the asset allocation decision made by the manager. Right? Are these a good decision or not? Well, you look at the weight of those of the actual portfolio and index return. Then you time excess weight with index return to get a contribution to the performance. For example, here you time 10% excess weight with 5.8% of the stock market. You get 58 basis points. That is good because it's positive. That positive means that, okay, manager did a good job in allocating more money on the stock market. That's why they earn 58 basis points more return than the benchmark. And in the fixed income asset class, this manager underweight. They decide to invest less. That's why, relative to the benchmark, they underperform by 33 basis points. That is negative, which means it's no good, because if you invest more money in fixed income security than the money market, you can earn more. But actually, they earn less than the benchmark portfolio because they allocate less in the fixed income security. And for the last item, they allocate 13% more in cash, and actually money market instrument also delivers more amount of return, and they contribute to 6 basis points of the excess return. So when you add three items together, all right, they did well in allocating more money in stocks. That's good, 58 basis points. But they didn't match the benchmark portfolio in terms of fixed income security. That's why they underperformed by 33 basis points and 6 basis points outperformance on the cash market. Overall, it's 0.31, which means the asset allocation decision in this managed portfolio contributed to 0.3% of excess return relative to the benchmark portfolio, or 31 basis points. Now, let's take a look at Table B, contribution to individual security selection. Once manager made a decision on asset allocation, they also need to make a decision on which security to buy or sell. And in this case, we should look at both equity and fixed income. And for the managed portfolio, for their equity portfolio, of course, they do not have a passively managed equity portfolio. Instead, the manager decided to pick their own stocks, and actually they did well. Market average is 5.8% for the equity market, but they deliver 7.28%. So the individual security selection in their equity portfolio is much better than the market average, and excess performance here is 1.47%. Then we time this with the portfolio weight of the equity to get the contribution of 1.03%. 1.03%. This 1.3% means that the managers are pretty smart. picking those outperforming stocks in their equity portfolio, and actually it contributed to a little over 100 basis points for the excess return. And for the fixed income security, the benchmark delivered 1.5%, and the security selection in the managed portfolio actually did a little bit better. They delivered 1.89%. Excess performance is 44%, but since they do not allocate a lot of money in their fixed income security portfolio, therefore the contribution is only 3 basis points. So through this table, you see very clearly that this managed fund did better than the benchmark, right? And the total amount of excess return is 1.37%. And this table showed you what contribute to what, right? And essentially speaking, you can say that, okay, this fund did a really good job in picking individual stocks, right? Because their security selection decision in the equity portfolio contribute to 103 basis points for the excess return. Right? So that is the strength for this fund. And for the asset allocation, they also delivered excess return. And overall, they did a really good job allocating assets, especially in the equity portfolio, right? And but overall, it's 30 basis points. But what they didn't do really well is the asset allocation in fixed income security, because it offset 33 basis points for the excess return. And their decision for the equity asset allocation is great. It contributes to nearly 60 basis points of excess return. Right? Although they did really good picking individual bonds, but it contributes much less for their overall performance in terms of individual security selection, mainly because the asset allocation is too low for the fixed income security. So this table showed you how we can do performance attribution analysis. And this performance attribution analysis is a great managerial tool for money manager. So they will know, okay, what did they do well, right? And where are the strengths, and how can they improve their future portfolio practice. And attribution analysis can go a little further than just asset allocation versus security selection. And manager can go a little further to see what did they do. After they do asset allocation decision, allocating assets into a broader asset classes such as stock and bond, they also need to do sector selection before they make individual security selection. Sector selection means they allocate certain amount of money into different sectors. And this table showed you how this fund actually make decision on sectors, and how those sector decisions contribute to overall performance. Right? So here you essentially found the difference between sector allocation versus in the portfolio versus sector allocation in S&P 500. And the difference in those weights are sector allocation decision. Anytime those difference in weights where the sector returns, you get a contribution of sector allocation decision to your overall performance. Right? So in this case, a negative number means not good, but the positive number means it's good. And actually, it's very obvious that the money manager did a really good sector allocation decision in a sector called consumer non-cyclical. It contributes to nearly 2% excess return for their portfolio. Right? But manager cannot do everything correct, and they didn't do a really good job in basic materials, capital goods, consumer cyclical sectors. They're supposed to. They underweight those sectors, but actually, if they overweight, they can get a higher return. They also didn't do a really good job in energy and the technology, but in terms of magnitude, it's not a big deal. And overall, when you combine everything together, overall, you would say, hey, this manager did a really good job in sector allocation. Doesn't mean they do everything correct, but since they overweight in consumer non-cyclical sector and contribute a lot to their excess return, overall, it's good. So here's a summary for attribution analysis. Right? And overall excess return is 137 basis points. Where do they get that 137 basis points for excess return? The answer is here. Asset allocation contribute to 31 basis points. Right? And security selection contribute to the rest. And it's very clear for you to see that security selection in the equity portfolio contribute 103 basis points, and very small contribution from the fixed income individual security selection. And also between the asset allocation and security selection, you also see that the sector allocation contribute tremendously to the overall performance, which is 129 basis points. Right? So where are the strength? The strength of this fund is in the equity investment, right? And the fund did a really good job in overweight the investment in consumer non-cyclical sector that contribute 129 basis points to the overall return. Right? So this fund did good in making a sector allocation decision within the equity portfolio, and also they did a really good job in picking individual securities in their equity portfolio. But certainly they have a lot of room to improve for their fixed income portfolio management as well as asset allocation. Right, so that is pretty much what we need to know for this chapter, and there's a little bit more to address, which is associated with the market timing. So what is market timing? And the market timing means that the manager actually adjusts asset allocation, trying to capture the gain from the market volatility. And the market timing often involves shift between stocks and the money market instruments or bonds. Right? And at a certain time, you might expect that, okay, stock market may continue to increase, but the bond market will decline. In that case, you want to move your assets away from the bond portfolio towards stock portfolio. Right? So here, you are timing the market, trying to maximize gains. And this is so-called market timing. And a lot of people wish they have greater capability to time the market, but the empirical evidence shows that most fund managers do not have consistent capability to time market well. That is the reality. Maybe in the future it could be changed, but during the past there's no consistent evidence showing that any fund has superior capability to time the market. So that is content that we need to cover for chapter 18, performance evaluation. Now let's spend some time look at those homework questions. Chapter 18, performance evaluation. Number 1. A mutual fund with a beta 1.1 has outperformed the S&P 500 over the last 20 years. We know that this mutual fund manager, okay, A, must have had superior stock selection capability, B, superior asset allocation ability, C, has superior time capability, and D, may or may not have outperformed S&P 500 on a risk-adjusted basis. And I would say D is the best, because when you do performance evaluation, you have to look at risk-return trade-off. Right? Outperforming means your return is higher than benchmark, but it doesn't say you beat the benchmark on the risk-adjusted basis. So we have to measure the return on a risk-adjusted basis. Right? And simply put, this mutual fund beat S&P because they bear more risk. You see that? The beta is higher than market of 1. They have beta 1.1. They're supposed to be the market, right? Just by how much? Number 2. Suppose that over the same time period, two portfolios have the same average return and the same standard deviation, but portfolio A has higher beta than portfolio B. According to Sharpe ratio, the performance of A is better or same or poorer than portfolio B. Well, I mean here, you needed to know, according to Sharpe ratio, how to calculate Sharpe ratio. Well, Sharpe ratio equals excess return divided by standard deviation. And in this question, those two portfolios have the same standard deviation. They have the same average return. Therefore, they should have the exact same Sharpe ratio. So B is the best answer. Number 3. Risk return rate, average return, standard deviation betas for 3 funds can be found in this table. And the question is here, if these portfolios are sub-opponents that make up a part of a well-diversified portfolio, then which one is preferred? Right? So with all the numbers that you see here, of course, you can develop several different performance measure. But you need to pick one that fit into your situation the best. And in this case, I tell you that these portfolio are subcomponents that make up part of well-diversified portfolio. In this case, which one's best? You can review the lecture notes, right, to see which one's best. The alpha, is that alpha or M square or Sharpe ratio, right? And the Sharpe ratio is no good. And looks like this trend measure is really good measure that you need to utilize, because used to evaluate portfolio that is part of a larger portfolio with different managers. So trend measure, it equals excess return divided by beta. Excess return divided by beta. Alright, so from here you can calculate excess return. Right, by taking the difference between average return and risk-free rate. Excess return for A is 13%, B is 20%, C is 15%. Then you divide this number with beta, and you choose the one that has highest value. And here, B will have the highest trend measure. Number 4. Okay, once again, you have table. You have average return, standard deviation, beta, as well as market return, right? And you want to evaluate 3 mutual funds using Sharpe ratio. This time, Sharpe ratio, right? And how to do calculation? Sharpe ratio equals excess return divided by standard deviation. Right, standard deviation. So when you do calculation, you will find fund B delivers highest Sharpe ratio, right? Average return divided by standard deviation. The excess return divided by standard deviation. So how to get excess return? That's the difference between average return and this risk-free rate of 6%. Right? Number 5. Similar table that you see here, and in this question, you want to evaluate 3 mutual funds using Jensen's alpha. Okay, it's Jensen's alpha. And how to do Jensen's alpha analysis? Well, first of all, you look at expected rate of return based on beta, not standard deviation, based on beta. Right? For example, for fund A, what is expected rate of return? Expected rate of return equals, for A, equals risk-free rate 6% plus beta 1.1 times market premium, which is the difference between market return 12% and risk-free rate. Right. So here you get expected rate of return of fund A, 12.2%. 12.2%, is that correct? Actually 12.6%. Right. Then this alpha equals your actual return, 13.6%, minus this expected rate of return. So the alpha is 1%. Right? And then you do the calculation for B and C, and you pick the answer that has highest value, which is the B in this case. Right? Number 6. Here you have weight and return for bonds and stocks. Right? And total return is 16% for Simon Arm Mutual Fund. And here you see a bogey portfolio. Right? That is a benchmark, and the return is 12%. It is 12%. So here we needed to do attribution analysis. So here is managed portfolio, and here is a benchmark portfolio. The first question asks you the total excess return on a managed portfolio was, well, you look at managed portfolio performance, 16%. And the benchmark has 12% return, so the total excess return is 4%. Very simple. Right? So the next step is to figure out what's the contribution from asset allocation decision. And what's the contribution from individual security selection decision. Right? So here, number 7. It asks you contribution of asset allocation to the total asset return is what? So here you look at, first of all, you look at asset allocation. And here's the standard the benchmark portfolio, 60% in bonds, 40% in stocks. And in your portfolio, you underweight bonds, but overweight in stocks. So here is the difference in weights for bonds, which is negative 0.4, and 40% overweight for stock. That is your asset allocation decision. Then you times those two ways with market return, 10% for bonds and 15% for stocks. And the calculation will show you 0.02. That means asset allocation contribute to 2% of your excess return. Now let's do individual security selection contribution analysis. And here you look at return difference. Right? And you return 12% on the bonds and 17% on stocks, relative to 10% return on bonds, 15% on stocks for the benchmark portfolio. So actually you outperform in those two different asset classes. So here is the difference in return, 2% for bonds and 2% for stocks. Then you times those two numbers with weights of bonds and weights of stock in the managed portfolio. And calculation will show you another 2%. That is the excess return that can be attributed to individual security selection decision for this managed portfolio. So from number 6 to number 8, you see a very simple example on how to do attribution analysis. Number 9. What calculates reward to risk trade-off by dividing average portfolio excess return by portfolio beta. Alright, that is a Treynor measure, not a Sharpe ratio. If it's Sharpe ratio, it's ratio of excess return and the standard deviation. If you use a beta, that is Treynor measure. Number 10. Information ratio is equal to a stock's what divided by what. Right, so information ratio equals alpha divided by its diversifiable risk. Number 11. portfolio performance is often decomposed into various subcomponents such as return due to, 1, asset allocation, 2, sector allocation. Third one, security selection. And the one decision that contributes most to the fund performance during the last 100 years for all mutual fund managers is A, asset allocation, B, sector allocation, C, security selection. Which one's best? And based on a historical observation or empirical data, it is asset allocation. Asset allocation contribute most, although in the example that you see in the textbook it's not, but in the history, empirical data show you that asset allocation contribute the most to the fund performance. Last one. A fund has access to performance of 1.5%. In looking at a fund's investment breakdown, you see that the fund overweighted equities relative to benchmark, and the average return on fund's equity portfolio was slightly lower than equity benchmark return. And the access performance for this fund is probably due to what? Right, so let's simplify the situation a little bit. This fund has access performance, which means this fund did better than the benchmark, right? And this access performance can be contributed to either asset allocation or security selection, or both. And here you see that the fund overweight equity, right? But return on equity portfolio was lower than the benchmark. Return of the equity portfolio was lower than benchmark, which means individual security selection was not successful, right? So individual security selection was not successful, but overall performance is good. So what's left here is asset allocation. They had, the asset allocation has to be good in order to generate overall positive access return. So the answer is C. Right, so that concludes chapter 18, performance evaluation.